Have you ever wondered how to take your options premiums and turn them into real long-term profits? Today, I'm going to show you my Snowball Strategy, a simple yet powerful way to reinvest your earnings from the wheel strategy and grow your portfolio over time. This approach is perfect for traders who want to maximize their returns while building wealth for the future. And the best part, I'm actively running the strategy on Intel, so I'll not only explain the steps, but also walk you through a real-life example to see how it all works. We are running a version of the wheel strategy, so if you're not familiar with that, I will give an overview, but you can also watch the linked video for a detailed guide. But enough of the fluff, let's get into it. The strategy here is pretty straightforward. We're going to be taking the premium you earn from selling options and reinvesting them directly into the underlying stock. And I want to be clear, just like with a traditional wheel strategy, you only want to do this on stocks you really like, and ideally it's also a stock that's included in the S&P 500. AMD fits both of those requirements, so let's use this as an example. Pull open the option chain and start by selecting your expiration date. This is fully up to you and how aggressive you want to be with building your snowball. I would recommend not going longer than 45 days to expiration just because this is primarily a theta harvesting strategy. So do monthlies if you want to be more hands-off, or weeklies if you like the action. I'll be doing weeklies for this video. If you don't already own the stock, you'll start by selling cash secured puts. Since our goal is to be reinvesting the premium into the underlying stock, we want to make sure that we're going to be getting enough premium to do so. So target strikes with at least enough premium to buy one share. The math is pretty easy here. Just look for a premium that matches the current stock price. This will generally be around a 0.3 delta. Here we can see that the 123 strike put is selling for $145. AMD is currently trading for $125, so we can easily buy one share of AMD with this premium received from selling this put. Looking at the order form here, we can see that this trade will require $12,300 as collateral. This is going to be our initial investment, or the starting point for a snowball. Once we sell this, we will receive $145 less the fees up front. And there's a few things we could do with this upfront money. We can either purchase one share of AMD right off the rip, or we can wait till it pulls back a bit or drops closer to or below our strike price. You can definitely cost basis hack this, and I normally like to wait for a 2 to 3% pullback before I buy, but to be honest, it doesn't really matter when you buy the share as much as you may think, because technically it's a free share regardless because it's fully paid for with the upfront premium. And this plays out just like a normal cash secured put. If AMD doesn't drop below our strike price, the option expires worthless and we just sell another put and buy another share. Ideally, we just keep doing this and it never gets assigned. And eventually we acquire 100 free shares and we can start selling 2 options instead of 1. However, if AMD does drop, no big deal. If we get assigned, we pick up 100 shares and brings our total share count to 101. And then we can start the next step, which of course, just like the wheel strategy, we start selling covered calls. Pro tip, make sure that you always sell above your entry point to ensure that you don't start shrinking your snowball. If you need to wait a little bit for the stock to recover, no big deal. We are aiming for higher returns over the long run. Patience is key here. So we continue targeting the same premiums, enough to buy at least one share. And the math is the same, and it'll generally be around that 0.3 delta. Now with AMD trading at 126, the 129 strike is almost there. But what are we gonna do? Pick the 128 or the 129? Well, here's a quick trick. I'm roughly $5 too short to buy the one share of AMD with the 129 strike call. So if we just divide that premium amount that we want by the delta, it'll actually give us how much AMD has to increase to give us that desired premium. So if we wanted just $10 more of premium, we can divide 0.1 by 0.3018, which was the delta of the 129 strike call. This gives us 33 cents, which means AMD would have to increase by 33 cents, or roughly a 0.2% move to get us to that extra $10. So barely anything. Plus, I would prefer to sell the call on a green day anyways, so let's pick the 129 strike call, but we're gonna change our limit price to be $10 higher at 130. Now we can just let this limit order ride, and if AMD does go up a tiny bit, we will likely get filled. If not, no big deal. Just let the order cancel out and try again later. So that's just a quick trick, but of course you could just pick the lower strike, fully up to you. Now, similar to the put side, if AMD stays below our call option strike price, it's going to expire worthless and we can continue to sell more covered calls and buying more shares. But eventually we will get assigned. And when this happens, there actually is a slight difference from the wheel strategy when we get assigned on the call side. That is because we're also collecting share profits. And in this quick example, we bought in at 123 and sold at 129, which resulted in a $600 profit. So what do we do with that money? Should we just buy 4 shares right off the rip? Well, you could, but instead, I would keep that money as a collateral boost for re-entering with cash secured puts. Remember, originally we started with an initial investment of $12,300, but now the stock is trading higher, so we will need more money to cover the new puts. Now, as we return to selling puts and buying more shares, eventually we get exercised. And at that point, we can use the shares profit to buy more shares. And we do this by subtracting the initial profit from the difference of the call assignment and the put assignment. So if we ended up getting assigned at the 125 strike put, that would be $600 from the initial minus $400 from the difference between the 129 and the 125 strike, meaning we're locking in $200 of profit to be used for additional shares. If this profit is not enough to buy an additional share, no big deal. Just keep it on the side until it grows enough to buy an additional share. Now, this might start seeming more and more involved, but like I said at the start of the video, I'm actually running this strategy on Intel, and I'm going to show you that in a second. But if you're enjoying this video and you're finding any of the tips helpful, please hit the like, drop a comment, or consider subscribing. It's completely free and means a lot to me. As I said, I am running this strategy on Intel. I'm about 5 months in, and I started with an initial investment of $2,000. And over those 5 months, I've been able to buy 31 shares of Intel solely from the premium received from selling options. And I'm sitting at just under $700 of total profit. But as you can see here, Robinhood doesn't really give you good metrics on your actual return. So that's why I'm tracking externally. I'm sorry if this looks like a total data dump, but this tool I built helps visualize what's been going on since I started this strategy. So you can see that I started this on August 7th, and I've been trading weeklies relatively consistently over the past 5 months. And you can see that I've been exercised roughly 3 times so far, and this helps give a good perspective on the frequency of how often I am getting exercised. Over here to the right more, I have a breakdown of my profit and return. You can see my total return so far on this $2,000 investment is 33%, and the profit from that is about just under $700, as I said before. I am using this sheet to track additional strategies, but we'll save that for a different video. Continuing with the Snowball strategy on this other tab here, I am checking when I buy shares and the profits I have left to buy additional shares. As I said earlier, you can just buy in right when you sell the option, but for me personally, I try to wait for good entries, and I track that all here. My average cost basis, you can see, is $22.23 per share. My total share count is 131, and I've collected a total of $669 of profit. I've used all but $7 of that to purchase shares, and you can see that I've been buying back in, increasing the size of my Snowball. Once I eventually get to 200 shares, I can double down and sell 2 options per week, which is really going to cut the time in half to get to 300, and so on, which really shows the power of this strategy. So with this strategy, you can see how it will continue to grow faster and faster over time. Every time you acquire an additional 100 shares, you can sell an additional contract, bringing in even more premium. And that's the Snowball strategy. Of course, there is a lot more to discuss with the management, the stock selection, how to repair or roll, but I'll leave that for another video. Happy trading.